Hello, welcome to Business Decode channel, where we provide insights that expose financial secrets. We help you understand viable ways and platforms to protect your income, grow your savings with minimal risk. Today, we will be shedding light on how banks grow wealth. According to a November 2024 survey from the Federal Deposit Insurance Corporation, this is FDIC, this is the insurance body that insures money in the bank, approximately 96% of US households have a bank account and put their money in the bank. And it is not a coincidence that 95% of Americans are not rich. Let me tell you a little known secret about how banks grow wealth. Imagine walking into your bank, you trust them with your money, but do you know where they put their money? The truth is, banks don't let the money lie idle in your savings account. They pour billions into something called bank-owned life insurance. Why? Because it offers safety, steady growth, and long-term financial power. If the biggest financial institutions in the world are using this medium, this platform, I wonder what you're waiting for. As at March 2025, this year, US banks have invested hundreds of billions of dollars in life insurance assets. Now, this is based on the usbanklocation.com. You can see that the Bank of America has $24 billion in cash value life insurance. JP Morgan has up to $12 billion. PNC Bank, $11 billion. You can see the link on the screen to verify. This is a strategy that forms the backbone of their long-term financial growth. Now, let us reason together. How much do you make in that your savings in the bank account? If you are just using a checkings account, you will be at 0.3% savings or interest rather. If you have a savings account, which will not even get up to 1%, or if you decide to do certificate of deposit, which is more like fixing your money in the bank, is going to be between 3 to 4%. Do you know what banks make by fixing your money in cash value life insurance? They make up to 7 to 15% interest, and that's the money that you're going to put in your savings or in the certificate of deposit. And that money compounds. Not only that, they also get tax advantaged growth and higher returns. So, what do you think? Now, let me walk you through this eye-opening example. Henry has $50,000. He doesn't want to take risk by putting his money in the stock market. So he chooses a certificate of deposit by fixing his money at the bank at 4% interest. At the end of the year, Henry earns $2,000. But here is the catch. That $2,000 will be taxed. So Henry's take home will be less than the $2,000. Now, let's look at what happens behind the scene in the bank. The bank doesn't let Henry's $50,000 just sit there in the account. They put it into cash value life insurance. That money compounds at 4%. At the end of the year, this same 50,000 grows up to $80,000. And the bank's gonna walk away with 30,000 without any tax on that money. The big lesson is here that banks don't take risk with their own money. They leverage your deposits. They earn multiples of what you pay, often without even paying tax. Meanwhile, you can't even go home with your small share. Banks are leaving their money in their savings. They are not leaving the money in their savings accounts, and neither should you. The wealthy copy what banks do because it works. So today you have the chance to assess this same kind of strategy. Let's sit down for 30 minutes and have further conversation on how you can leverage this strategy. Thank you as you send us an email to this or you call this number. Let's talk further, free of charge. Thank you.